Hello, everyone. So we're going to be doing the presentation on the collapse of the Lehman Brothers, the 2008 financial crisis. I'm Ariel.
I'm Leo.
I'm Brandon.
All right, let's get started. So the Lehman Brothers was one of the most influential investment banks on Wall Street before the 2008 financial crisis. The firm dated back to the 1850s, but in the early 2000s, it grew aggressively during the housing boom. Lehman made a lot of money through investment banking, trading, and asset management, but its biggest profit came from mortgage-related investments. During this period, the company pushed for higher returns by expanding into more complex and riskier mortgage-backed securities. Because housing prices kept rising, it looked like a safe and extreme profitable strategy. But this also meant Lehman was becoming heavily exposed to the mortgage market. As long as home prices went up, the bank looked strong. But once things slowed down, those risks became a major problem. One of the biggest reasons Lehman collapsed was its huge exposure to subprime mortgages. These were loans made to borrowers with low credit score, unstable income, or limited ability to repay. The bank bundled these risky loans into mortgage-backed securities and collateralized debt obligations because they produce high returns. Lehman kept increasing its investments in these products because housing prices seemed stable, but when homeowners began defaulting in 2007, the value of these securities dropped sharply. Lehman was holding billions of dollars in assets that suddenly became worth far less. This created enormous losses that the bank could not cover. The collapse in subprime mortgages was the first major hit that started the downward spiral. Another major factor in Lehman's failure was its extreme high leverage ratio. By 2007, the company had a debt to equity ratio of more than 30 to 1. That means for every dollar of equity, Lehman borrowed about $30. This magnified this magnified profits in good times but multiplied losses when the market turned. The company also relied on short-term borrowing through the repo market, which meant it needed lenders to renew these loans every single day. When investors lost confidence, that short-term funding dried up quickly. Lehman had taken on too much risk without enough capital to protect itself. Its internal risk management controls failed to recognize how vulnerable the firm was, making it impossible to survive once markets started collapsing. In 2007 and early 2008, many warning signs show that Lehman was in trouble. Mortgages defaults were rising and banks was forced to report billions of dollars in losses. Rating agencies like Moody's and Standard and Poor's downgraded the company's credit rating, which reduced confidence even more. Lehman's stock price began to fail rapidly, signaling that investors no longer trusted the firm's financial health. The bank tried to raise capital and even looked for buyers, but no deal was successful. By the summer of 2008, Lehman was running out of time and liquidity. This situation became unstable, and these warnings led directly to the events that caused the firm to collapse in September 2008. This background sets the stage for the crisis that unfolded in 2008. Now I'll hand it over to Leo, who will explain the collapse itself and why Lehman was ultimately allowed to fail.
The Lehman Brothers was the fourth largest investment bank in the US, but by 2008, it was extremely exposed to subprime mortgages and risky mortgage-backed securities. When the housing market collapsed and mortgage defaults increased, the value of those assets fell sharply. Investors and lenders quickly lost confidence in Lehman's balance sheet, and the firm could no longer raise the short-term funding it needed to operate. On September 15, 2008, after failing to secure a buyer over the weekend, Lehman filed for bankruptcy. This was the largest bankruptcy in U.S. history, and it marked a turning point in the financial crisis because it shattered the assumption that all major banks would be rescued by the government. For the timeline, the chain of events began years before the failure. Between 2003 and 2006, Lehman aggressively expanded into subprime and adjustable rate mortgages to boost profits. In 2007, when the U.S. housing market began to crash, the value of Lehman's mortgage related assets dropped dramatically. In March of 2008, the collapse of Bear Stearns raised concerns that Lehman could be the next vulnerable bank. Throughout the summer of 2008, the firm reported massive quarterly losses and its stock price fell more than 90%. During the weekend of September 12th through 14th, the Federal Reserve and the Treasury Department tried to help facilitate a sale to either Bank of America or Barclays. Both deals fell apart because neither buyer wanted to absorb Le Mans' toxic assets, with no buyer, no government. By the third quarter of 2008, Le Mans reported a 6.7 billion loss, although the real losses were likely much higher because many assets were overvalued on their books. The firm technically held more than 600 billion in assets, but much of it consisted of mortgage-backed securities and real estate investments that had collapsed in value. When the bankruptcy was filed, it immediately became the largest in US history. The failure caused panic across the financial system because so many banks, hedge funds, pension funds, and money market funds were connected to Lehman through loans and complex securities. Once Lehman failed, many creditors were left exposed, and forced selling began around the world. One of the biggest questions is why Lehman Brothers wasn't rescued the same way Bear Stearns, Fannie Mae, and Freddie Mac were. According to the Federal Reserve and Treasury, there were a few major reasons. First, they said they lacked the legal authority to guarantee Lehman's risky mortgage assets without a buyer willing to take on the firm. Secondly, every potential buyer demanded the government cover tens of billions in losses, something regulators refused to do. There was also concern about moral hazard. Policymakers felt that constantly rescuing failing financial institutions would encourage even more risk taking. Finally, there was political pressure. Congress and the public were already angry about earlier rescues, and officials feared backlash if they offered another bailout. As a result, Lehman became the institution where the government drew the line and became a major bank to fail. The consequences were immediate and worldwide. Stock markets around the globe fell sharply in the days after the collapse. Banks became afraid to lend to one another, causing the credit markets to freeze. This freezing of credit was extremely dangerous because short-term lending is what keeps companies, banks, and even governments operating. Money market funds, which are normally considered extremely safe, suffered losses tied to Lehman, and one major fund broke the buck, meaning its value fell below $1. This created panic among everyday investors. Le Mans' failure accelerated the financial crisis and forced governments around the world to intervene with emergency programs such as TARP, massive liquidity injections, and new regulations to stabilize the financial system.
The aftermath and lessons. The failure of Lehman Brothers caused a catastrophic credit market freeze and sent shockwaves through the world's financial system. Almost immediately, banks all across the world lost faith in borrowers' ability to repay loans, making them reluctant to lend to one another, as well as to consumers. This credit restriction forced economies into a severe and protracted recession and exacerbated the already developing 2008 financial crisis. Financial institutions faced a decline in the value of their assets, households found it more difficult to obtain loans, and businesses battled to secure finance for basic operations. Massive stock market sell-offs and a sharp drop in economic activity resulted from the global collapse of investor confidence. The United States implemented extensive reforms in the wake of Lehman Brothers' demise and the wider financial crisis with the goal of averting another systemic catastrophe. The Dodd-Frank Act, which passed in 2010, and drastically changed the way the financial sector is regulated was the most important of these. Increasing monitoring of big interconnected financial institutions whose failure could endanger the economy as a whole was one of its main objectives. These institutions had to pass frequent stress tests under the Dodd-Frank Act to demonstrate their resilience to severe economic downturns. In order to ensure that banks had stronger financial cushions to withstand potential losses, the law also mandated higher capital requirements. The Volcker Rule, which prohibited banks from participating in specific high-risk speculative trading activities that had led to instability prior to the crisis, was another significant aspect of the law. The act also established the Consumer Financial Protection Bureau, an organization tasked with keeping an eye on financial products and shielding consumers from dishonest or unscrupulous business activities, in order to make a failure like Lehman's much less likely to occur again. Dodd-Frank sought to improve the financial system's resilience, decrease extensive risk taking, and boost transparency. What could have been done differently? In retrospect, a number of crucial steps could have considerably lessened the impact of the financial crisis and lessened the severity of Lehman Brothers' demise. First, there would have been a significant impact if large financial institutions had improved risk management. Many banks maintained unduly optimistic evaluations of their exposure and underestimated the risks associated with complicated mortgage-backed securities. Institutions might have been pushed to address their vulnerabilities sooner and take corrective action before the situation worsened if losses had been acknowledged earlier rather than being concealed or postponed. Additionally, stronger capital and liquidity buffers would have been essential. Banks would have been better able to withstand shocks and continue lending during difficult times if they had been obliged to maintain more dependable reserves. Furthermore, the crisis might not have gotten to such a catastrophic level if regulatory action had been more forceful and well coordinated. Since regulators frequently operated in silos, better communication between them would have produced quicker, more cohesive responses. Lastly, rather than rushing at the last minute to deal with failing banks, a more defined, pre-planned strategy may have decreased uncertainty and helped avert the global panic that rocked markets. Recommendations for preventing future collapses. A number of long-term changes are necessary to lessen the possibility of another crisis, such to the one that occurred in 2008. First, authorities need to keep a closer eye on big linked financial companies, particularly those whose failure could put the entire system at a danger. To justify the risks they incur, these institutions demand stricter regulations, more regular audits, and increased oversight. Maintaining strong capital and liquidity standards is also essential. Banks are much better equipped to withstand unexpected shocks and carry on with operations even during times of extreme stress, provided they have adequate financial cushions. Increasing the transparency of complicated financial instruments is another crucial step. Even specialists found it difficult to comprehend the risks associated with many securities before to the crisis because they were so opaque. Investors, regulators, and institutions would be able to make more informed decisions with the support of standardized reporting and clear disclosures. It is equally important to strengthen crisis management tools. Regulators can safely wind down failed institutions by using measures like orderly liquidation authority, which lowers anxiety and stops uncontrollable breakdowns. Lastly, the financial sector needs to promote a culture of prudent risk taking. This entails adjusting incentives to prioritize long-term stability over immediate financial gain. The financial system as a whole becomes more robust and reliable when organizations place a high priority on sustainability and accountability.